I'd love to get an update on your worldview right now, because you did moderate sort of your extreme downside target when it came to the S&P, but it does feel like your notes are chock full of warnings about concentration in a few names, obviously declines in buyback activity and dividend activity as companies preserve cash. How are you feeling?
So, Carl, here's how I think about it. Basically, all of the good and optimistic outlook is basically priced into the market today. So where the market's trading now, I would say the asymmetry of upside, perhaps 2%, and downside, maybe 15%. And the thought process behind that is, what is the market pricing? And the market at this juncture is trading at around 17 times multiple on our optimistic 2021 earnings estimate for next year of about $170. So to put that in some perspective, last year, 2019, the market earned $165. And my forecast for next year in 2021, looking through the trough this year, next year will be about $170. So that's actually a slightly higher level than we had before, looking back into 2019. So in that context, the market is trading on a 2-year forward basis on a very high multiple. Not the most extraordinary multiple, but a pretty high multiple. And the risk of activity and developments looking forward, as I think about it, is probably more skewed to the downside near term than the upside. And so there's modest upside. I do think the end of the year, the market will be a little bit higher than we are today, but not a whole lot higher. And the market is pricing in, as I said, a very optimistic, I think, likely scenario, but it's certainly not giving a lot of not a lot of cushion for portfolio managers.
Yeah. What you're describing, David, though, is what the bulls always say, and that is the market's looking through this incredibly volatile period we're in. What's wrong with that?
So, yes, absolutely. Market is a discounting mechanism, looks forward, and the developments, a lot of information is coming in every day. Well, here's some of the things that maybe aren't being embraced by some of the fund managers with whom I speak. So first of all, if we think about the amount of bank loan loss provisions that are likely to take place over the next 12 months. So my good colleague, Richard Ramsden, who's the banks analyst at Goldman Sachs, they calculate around $115 billion of provisions are likely to be made in the next 4 quarters against what's likely to be about $103 billion of losses, of loan loss recognition. And so that's a question. What does that suggest about either bankruptcies, about defaults, about loan quality in terms of the growth of the business? That's one example. We've got buybacks. It's the number one source of demand for shares in the last 10 years. It's something we've talked about for a long time with you and the viewers. That's not likely to be a big support level for the market. They're going to be down around 50% in the next 12 months. So we expect a big pulling away in terms of the money flow demand. Dividends, we had 40 companies already have cut, eliminated, or suspended their dividends. That's likely to increase, if you will, as we go through the year. Fewer companies looking to make those payouts. Capital spending also falling about 25% in the next year. So those are some of the issues. You got the risk of the election coming up. We're about 6 months away, a little less than that. The prospect potentially of a higher corporate tax rate. I come back to the valuation of the market. The market's trading now on our optimistic numbers around 17 times forward earnings. But if I went to you and say, well, gee, under a different tax scenario, you could have maybe $20 a share of earnings could have to lower your earnings estimates. Well, suddenly then the market multiple is closer to 20 times earnings. And that's, I think, the concern that I would have. So again, broadly speaking, the economic scenario is getting better. The hopefulness is that the second half of the year will see steady restart of the economy in different states. It's all priced in. Everything seems fully valued in the market today, and at these levels, I'm less enthusiastic about where we are.